Good morning and welcome to the latest in the series of Flexible Space Association Workspace Wisdom webinars. I'm Jane Sartin, Executive Director of FlexSA, and we're joined today for our webinar by Zoe Ellis-Moore of FlexSA member Spaces to Places. And Zoe is going to be talking about her latest report and lots of information on Flex. We will have time for questions at the end. If you'd like to put any into the chat box as we go along, we'll pick these up at the end. But I will hand over to Zoe. I'll put her presentation up and let her take us through it.
Amazing. Thank you so much, Jane, there. So, sorry, the formatting's gone a bit skew-iff, but bear with it there with the slides. So, good morning, everyone. I'm Zoe Ellis-Moore, as Jane said, the founder of Spaces to Places. And I'm going to take you on a journey this morning from where we currently are in the flex office sector to where we're going. So, here we go. So, where are we going? In some ways, let's look at where we are right now. I think that's always a good one. So we just released the latest report from Spaces to Places. So do download a copy there with the link ORE there. But I'm going to take you through it first and give you sort of the top line headlines of the report. So where are we now? It's an interesting one to think about a tipping point. Is the sector reaching a tipping point for me at the moment? Because what's happening is it's always been sort of the traditional lease market for offices of larger occupiers has been 90% plus in the market. And generally we're saying that 10% of the market is flex in the UK. But what's really changing now is significantly other players coming into the market. We've got landlords, or as I'm calling them, brandlords. We've got that managed product that's growing at a rapid pace. So this is really increasing quite rapidly the percentage of flex and the new providers in there with quite a bit of real estate stocks really changing their dynamics now. So this is where, you know, is there going to be a point? We've always sort of heard JLL talking about flex reaching 30% of the total office market. You know, when are we going to get to a real significant tipping point in the market? What's also happening is, you know, the sector's always had a long tail in some ways, providers with 1 to sort of 3 locations. And this is sort of a breakdown of the different tiers of providers by number of locations. And we've identified 229 providers in the UK with 4 or more locations here. And what we're seeing is quite a few brands now really scaling and growing from those sort of tier 4, tier 3, and tier 3, really growing up, so growing to those tier 1 levels. So it's exciting. But the other factors that we need to bring in is what's happening and changing in the whole world, to be quite honest. The huge technological advances will only get faster, with the mundane to most complicated tasks saving us time. So what does this all mean? Time now is one of the most valuable and infinite resources we have, just like money, oil or gold. However, unlike other commodities, it's non-renewable. Once it's spent, it's gone forever. And now we're starting to think about concepts on return on your time. You know, you're thinking life by design. And you're outsourcing what you're not good at or don't have time for. Some people now much more, you know, have a cleaner to save you time. And people are also asking, is it a good use of my time to go to the office? The other elements we've seen with this, with time being so precious, we've seen the erosion of the working week, that Monday to Friday, 9 to 5. If we reflect back in sort of history, we used to work 7 days, you know, on farming the fields. Then we worked 6 days in a factory and then 5 days in the office. Then we introduced hybrid working. And we're seeing that rise of the 4-day week. So lots of fundamental changes happening. What I find fascinating, though, is the unlimited vacational policies that have been put in place by the likes of Virgin, Netflix, Dropbox, HubSpot, Airbnb. These are, you know, recognizing that people can manage their own time and they want to as part of their job role. Another fascinating fact that I've been looking at is the decline in home cooking. You know, 35% of millennials say their lifestyle doesn't accommodate them cooking and preparing food. So hence the rise we've seen of cook, just eat, Deliveroo there. And this is an example where the cost is more, but the time saved is deemed more valuable. Similarly, though, linking it all back, you're probably thinking, where is Zoe going with this? It's all about, offices on a plate. People want it served to them. They seek to outsource what they're not good at. So that's the correlation. The other exciting trends and where we're seeing is, it's much more about a lifestyle workplace. In a sort of time-poor world, people crave experiences, and there's been a huge growth in experiences and services. It's all about a lifestyle workplace. You choose the business you work for as an employee now, and you move if it doesn't fit your lifestyle requirements. I thought just to sum up some of these trends here, we highlight what's happened really pre-COVID and it shows the lifestyle shift with experiences and the rebalance of priorities of, the different areas of work, leisure and life. So some significant changes there, but it's more you'll see all related to a lifestyle. So bringing it back to the flex office sector and thinking, how do we get there in some ways? How do we transition to the next evolution of flex offices? What's quite interesting is investors have been used to triple net leases and returns there. They're now finding they're not getting those same returns anymore. So they're looking at operational real estate, whether that's student housing, co-warehousing, hotels, flexible office workspaces. These are the sectors that link rich experiences for consumers with time, place, and opportunity. It's now much more of a mix to hypermixity, as the word's now being used. For example, the pictures here are from Social Hub. Social Hub have 23 locations in leading cities across Europe. It's a hotel, it's a co-working space, it's a halls of residence, it's a multifunctional use. Real estate now is becoming much more operationally intense and about placemaking. So if you've read the latest report from Workspace Group, it's fascinating. There's even a presentation version that you can download and the link there. This is really showing Workspace Group also doubling down, as they say here, on operational excellence. And really this rise now that we're all seeing of operational real estate. So it's happening across the board there. So yeah, do take a look. And the one thinking wider with operational real estate, we're talking about these trends and stuff. We've got examples here with Legal and General, with Inspired Living there. Also, we've got, which is a retirement, homes there. We've also got the package living there with Aviva investing, Schroders investing into hotels and stuff. So we're seeing increasingly, investors are taking on the operations or they're partnering with somebody because they're seeing it as an essential component for creating value and maintaining the sort of overall value of that asset as well. So it's not just sort of the flex offices with this, it's all the other real estate sectors, the operational real estate sectors. So here, this is our sort of just some analysis, subjective analysis that we're been doing to show where on the maturity curve that flex offices are. And we do see that the student accommodation, the build to rent sector, hotels being much more advanced on this curve and nearer maturity. So there's a lot that we can learn from other sectors. And this is what the latest report sort of reflects on and looks at some of these criteria to go, how can flex move up the curve and reach maturity? And really that recognition from investors that it's an investable asset class. So I think if we look at sort of, it's not there, but I think a really great one is if you look at what's happened with shared storage, the mum and pups business, but now it's an asset class in its own right and performing really well for investors. So how does the flex office sector move from where we are at the moment, growth? So I'll go through some of the growth signs and what we're seeing there. How does it move to signs of mature, the mature market that we need to move to and where the sort of future's going? So first of all, with signs of growth there, one of them, the first one there, is increased capital investment. we've seen a huge increase in the last 6 months. If you look on that chart, we've got Argyle there, Gilbanks, Industrious there, taking on institutional capital there. I think CBRE is really interesting. CBRE had a 40% stake, and they've taken on the remaining stake, valuing Industrious at $800 million there. And the other one last year, sizable deal, you can see there much more. The sizable deals really happened coming forward now was WeWork, of course, and Yardi. So Yardi taking on 60% there of WeWork. So lots has suddenly happened with increased institutional investment. So that was one of the signs of growth. Another sign of growth is expansion of the providers. Here I've highlighted the top 10 by number of locations, but in the report we've got a full rundown of the top 36 providers in a league table. So download the report to see that. But I think it just shows you these are the leading players by number of locations, not square foot. So like WeWork have substantial square footage there with each of their buildings. So if you took it by square feet, it would be up the league table on that side. So the other one that's as part of the criteria that we see with the growing sector is, diversification of models and sort of the sophistication of what's happening. This is one of our previous reports that we did earlier in the year, looking at leading providers with 10 or more locations and what was their model. In hindsight, we should have included sort of turnover or hybrid leases, because this is a category that's we've brought into management agreements, but it's growing really rapidly. So what we're seeing is a move to much more this partnership approach, especially new premium providers we found in our research who are hospitality-led are taking on much more management agreements. They're even running the whole building. So the dynamics and the sophistication of models is growing up in the market and changing there. Traditionally, we've seen lease is always strong there, and even sometimes where historically some providers where they're growing, they've been much more owner and operated orientated. And the next slide I'll go into, we're seeing the growth there of also owner and operator models. I think the statistic that I love and put in the report there, that's from Savills, and they were looking at the new deals. This is we took a whole snapshot of the current market, whereas Savills has looked at the new deals being taken on, and they've sort of shown that it went from 9% pre-COVID management agreements, and now sort of 41% they're saying of deals being done are actually management agreements. So huge changes happening in the market. The other big one, and with that tipping point that I really brought in, was seeing the increase, called them brand lords, but it could be propco, opco, but just giving some examples here with the whole of the UK. The research we did on the London Flex Brand Index was fascinating. We looked at 60 providers in London and then really highlighted the brand lords, 10 sort of brand lord providers with 4 or more locations. They've really come about an average of the last 6 years. We've seen this model, really come into fruition and get much more sophisticated. So lots of examples there. And in the report, you can read more. The other one that's growing, really changing the market, I would say, just to highlight there, is managed. And quite a lot of the brand lords, I would say, are much more end of the market. And we'll come into example with GPE, but they're entering into the flex office market at the managed end of the sort of scale. So Valve data, fascinating. They looked at from sort of 2019 to now, they've seen an 895% increase in the number of managed supply there. Likewise, the other statistics are from Rubberdesk, and they're backing it up as well. They've seen year-on-year growth, 111% there of managed availability. Sorry, it should be a dot there, 6.1%. But we're seeing managed growing sort of 10.6%, and then on the sort of traditional serviced office market, 6.1% there. So there's some of the highlights of the providers as well and logos. So we're seeing new providers like Compton's, even TSP coming into the market with their own offering, much more sort of a broker agency coming into the market as well. So lots changing, huge growth sector there, I would say, with the managed provision in the market. So the other one that's criteria, there's user growth and user demand, and also technology as well, number 5, that we put as the categories to show that this sector is maturing. We're seeing a lot with the technology side, getting much more sophisticated, linking up systems and data. So really starting to get much more investor orientated, because they want figures and they want real time. So we're really seeing a move to that. The other one is user demand. All these statistics are from Work There and from last month there. So they were saying they've seen the number of rise in inquiries, flex inquiries, and much more. They're seeing those briefs as well for managed and fitted space, 78% for those ones under 5,000 square feet. We're also seeing the value size, good value size there that people are looking for as well. So that's all highlighted report that we brought together, going, actually, there is the sort of user demand growth as well. And a lot of this I do see coming from the traditional sort of lease market, where we look at back to the scales and the tipping point, really going, customers are wanting, going back to an office on a plate, they want it all delivered for them, and this service, that's what they're really wanting. They're wanting offices, but also they want to outsource that whole function. So just coming on back to the sort of, this is the content of the report. If you read it and you can go through there. So the science maturity, these are sort of the categories there that we need to see to get a mature market there. We need much more transparency of data and standardized matrix. We need to work that out. And I think as an industry, investors want to see, income stability, longer lease lengths. They want to see professional providers, these evolving sort of capital structures and valuations. I think we can talk forever on the valuations as well, but that's what's needed to move on to the signs, get to the maturity level. So I think where I'm seeing these real signs of maturity and where data has been shared is, if you read the latest GPE annual report, they break down quite a lot of data that's really interesting and sort of really shows where we're going with some of these signs of maturity. They're looking at, over 500,000 square feet that they're managing in London, 25 buildings, 88 customers, and they're demonstrating this significant shift, I would say. The other one is average lease lengths. They're sort of for managed 3.5 years. So people are staying, they're showing that stability with demand and people actually that stickiness. They talk about their fully managed rent per square foot being £207. You can read all this detail, but this to me suddenly shows much more why GPE are coming into the market and the financial rigor and performance that's also proving that the sector is really investable there. So I think do take a look at that. And finally, I think just to say with this journey, in some ways, there's a few more bridges to build. We've got confusing terminology. We've made it really confusing for the customers. We need to solve this whole evaluations and data getting much more sophisticated. So we're getting there. We're building a few more bridges. So it's exciting to see where it's going, having looked at the other operational real estate sectors. If you want to know more, and for all those action takers in the room, do download Space Places reports there. The last one is the operational real estate report, so do download there, or the free reports. They sort of build as a series. Really thankful for the sponsors that we have there, DBJS as well, Newmark and Yardi, so supporting and really pushing forward with this industry as well. I'm Zoe Ellis-Moore, and it's been a total pleasure today to present a quick whistle-stop tour to you today. Really looking forward to questions, and thank you so much. And thank you, Jane.
Thank you very much, Zoe. You packed a lot of information in there. And we've already got a few questions that have come through. There's still a bit more time, so if you would like to ask a question, please put it into the chat box. Let's bring Zoe and myself back onto the screen, hopefully. There we go. Right, let's have a look at the questions, which at the moment don't seem to be wanting to go public. So I'm going to read them out. Here we go. Right. Could you say a little bit more on what professionalisation of providers means in terms of change?
So with scaling, it's very much investors are looking for a proven track record. That's really, I suppose, what it's insinuating with professionalisation of providers, being able to guarantee returns as well, and having metrics based on other properties as well. So that's the big one with professionalisation. It's much more about systems and processes to back everything up, and the metrics as well. So hopefully that answers. And I think we're already doing so much. In some ways, that word professionalisation in some way does it disservice. Everybody's really professional. It's that next level with operational real estate, where being able to prove things and have that track record for operational excellence. Yeah.
Okay, and there's a question on whether square feet rates per month or per year. I'm not sure if that links back to something.
It probably does. And I would say go through the GPE report, because I think that's where I just mentioned it there. They've got, so I've taken all their data, because you can then forensically analyze what they're saying, and it goes into quite a lot of depth and stuff. So then you can compare about yourselves. I think that's probably always going back to the real source there with GPE on that side, and they break it down.
And on data in general, Zoe, there's obviously a lot of information in your reports, and I'm guessing there's a whole wealth of sources. How do you go about that, you and your team, in terms of obtaining it, ensuring it's accurate and verifying it?
So our big one is always triangulating data sources. We've come from a world of hotels and retail being used to really rich data sources that you can trust. In this sector, we've got lots of different data sources, and whether it's from brokers, whether it's we use government sources as well, we're having to join up the dots. It's less sophisticated, or we're using traditional lease markets well, and standing markets as well. So our big one is always making sense of that data and double checking and checking, because sometimes you're just seeing a small slice of the picture. But it's a lot of tracking. We've got now building up much more, keep on building a data repository of checking and verifying sources, because I think AI especially, if you can, it's always knowing to trust the source. So that's a big one for us. And yeah, utilizing also the knowledge of everybody else and actually putting it down and sharing.
Yeah, and then I guess the longer this work goes on, then the richer that data is, because you're able to go back and compare and build a picture.
And I think that's the big one in some ways with the Win Group as well, with data share. We're getting that, data sharing on lots of different areas. Another one with the sort of thinking about the professionalization comment, it's being able to prove customer service. Like everybody says, they like 80% say provide superior customer service, but actually when you look at the data, sometimes that's 20%, much more in some ways. So it's having to be able to prove data is the next level that we get confidence in the market there.
And you've talked today and previously, and it's obviously something that's discussed a lot in the industry, that managed is growing a lot in the sector, and as you're calling them, brand lords are growing. Do you see traditional serviced office market continuing to grow, or is there just a fundamental shift?
I think the one that you look at is there's extraordinary growth with managed in some ways, and those figures coming through there with the managed. It's very much the sort of traditional serviced office is growing in different ways, but at lesser percent. And actually, I thought Rubber Desk was sort of 6%, they would say. We do find quite a few times buildings change. That's where with the data repository, we do see sometimes it just changes providers, a new provider comes in, different things there. So the growth and the real change, and hence that tipping point, was, really seeing managed side, and also the landlords sort of really, their traditional, we're called the brand lords, their traditional office leased portfolios coming towards flex, and where didn't include it, but in the report, does go down to definitions, because sometimes people are saying we're offering flexible leases, but and that's where it gets muddy. It's shifting because of customer expectations much more to flexibility, service package, it's a whole package for a customer.
I feel like language in our industry can cause quite a lot of confusion generally, whether in the UK or the difference between wording across different countries, but in English, it seems to be quite a challenge.
I think that is one of the other ones that, when you go back to the customer, they just want an office, they're less worried about how they, actually access and, buy that product. It's more about, does it fit the right boxes for them and tick lists and stuff. So yeah, I think we have in some ways overcomplicated everything.
Yeah, and I think that's something. It's a really important point for us to remember, isn't it? That we have to speak in a way that everyone understands outside, that isn't within the industry, because it's it's obviously the customers that are key to this. So we've just had another question. Could you please share the source of the square footage rates?
So if you go onto GP's website and their reports, it's the latest one. I want to say 16th of June. They've got a presentation pack in there that you can download and find, that because I think this is where the transparency is coming from, because they have to report into the investors. It's all shared online. So yeah, it's straight on the GP website under investors. And it's, I think, the latest presentation from their annual report is the slide that I just took there. You can dive into all the details there.
Okay, well, thank you very much, Zoe. I think we'll certainly share the recording of this webinar with everyone that's joined us this morning, and also those that haven't, and share it more widely, so that people can see that there was a lot of content in there, wasn't there? I'm sure people want to get that again. And also, as you've said, Zoe, your reports are available on the Spaces to Places website, and I think is it now 3 that you've produced?
Yes, it's sort of built up momentum. So any feedback welcome, because it helps with the next. What we have done is, sometimes we can't put everything in one report. We'll save it to the next, answering those questions that people have as well. So it keeps on evolving. The next one will be out in September. So much more will be on Voice of the Customer next, it looks like. And so yeah, keep on feedback. And if you've got any questions from it, do reach out. I'm quite happy to answer, because sometimes it can go into a bit more detail there. But hopefully with the presentation, it goes through the structure of the report and how you can see how evidencing different parts there.
Yeah. Okay, well, no, thank you very much, Zoe. That's been really helpful this morning. And our next Workspace Wisdom webinar will be taking place at 11 a.m. on Wednesday, the 23rd of July, when we'll be hearing from a GDPR expert. We're covering a whole wealth of different types of topics on these webinars, and I think GDPR is something that we probably still worry about a bit, and maybe it holds back from things. So I think about having a bit of a refresh on that and understanding what it means, particularly for the flex sector, will be really helpful. So information on that will be shared very shortly. We're also getting going with a new program of webinars and other activities around our new initiative, Flex Generation, which is targeted at people working in the industry aged 35 and under. Please do register an interest if that applies to you or you have colleagues, so that we can let you know what's coming up, and so that you can join those things. But we'll be rolling out more information on that over the coming weeks and months ahead. So thank you again, Zoe. Thank you everyone for joining us, and see you again soon. Bye-bye.
Have a nice day. Thank you. Bye.